Bank of America is claiming that we're in a bubble that's greater than that of the dot-com era. Is this just another doomsday prediction, or is there actually something to it? Today we're going to be breaking down the issues and going over both my predictions and what I will be doing with my money in the near-term future. Hey everybody, and welcome back. Every now and then it seems like it's inevitable that some big bank or big hedge fund or analyst comes out with a doomsday prediction about how the market's going to crash another 60%, how we're in a bubble, how valuations are stretched and too high. But most of these predictions are just bears being bears. I mean, there are plenty of people who make a reputation on Wall Street of just being a bear to drive fear, make people sell out of things. We really need to be careful about analyzing the points that the bears are making, because a lot of the times they're actually wrong. But every now and then, they might be right. So let's break down Bank of America's claims, analyze them, and make a decision on what we should do with our money in the market. This article starts off by saying, as investors continue to pile into growth stocks, sometimes passively, the market has started to resemble the so-called Nifty 50 and dot-com bubbles in the 1960s and late 1990s. And while stocks could still rise in the near term, outcomes after those famous bubble periods suggest trouble could be coming. So throughout the article, they show these different figures in support of their claims. This graph shows us that compared to global equities, U.S. equities are valued far higher and have far outperformed in the last few decades. Currently, we're 3.3 standard deviations above the mean, which is kind of crazy. And it does seem bubblish, especially when you compare it to the last 75 years of data. The question is why? Why would this be happening? Is this really a bad thing? I talked about this in my video on the speech that J.D. Vance gave. The U.S. is a powerhouse, and it's been a powerhouse for a reason. We allow our companies to innovate and create as they please. We have some regulations, but when you compare us to places like Europe, it's no contest. We allow our companies to grow quickly. We have high access to capital. There's so many things that contribute to the United States' dominance, and so this chart really doesn't surprise me in the least. The United States allows their companies to go fast and print cash, man. This is freaking NASCAR. If you're not first, you're last, baby. The second figure looks at the market concentration of the top 5 companies as a percent of the S&P 500. So this is looking at Apple, Microsoft, Nvidia, Google, and Meta. By market cap, those names are currently making up 26.4% of the entire S&P 500 index. Wowie, that is a lot, I will admit. But is there a reason for this? Honestly, I think so. When you look at those top 5 companies, they are printing billions and billions and billions of dollars of free cash flow every single quarter. These companies have innovated extremely quickly. They grow at a really fast pace. I would personally argue that the top 5 companies in the S&P 500 are actually pretty fairly valued. Some maybe even undervalued. But look at Google. I mean, they're rocking a low 20 PE right now. When we think about this, we have to really think about what is a bubble in the first place. A bubble is when the companies within the market are highly overvalued. If you've ever poured like soda into a can, right, you get a little bit of soda and a ton of foam. A bubble is when you have all of the foam on the top and just a little bit of soda. But I don't think that's the case at all in our market. Don't get me wrong. There are some companies that have tons of froth. However, when you look at the top 5 companies in S&P 500, their valuations really aren't stretched that much. You're going to have a very hard time convincing me just because these top 5 companies are dominant market players and they have high growth and high demand for their services and products. That doesn't necessarily mean that we're in the middle of a bubble. It just means that there's a few companies dominating. I want you to take a look at this. This is the net income year-over-year change expected for the Magnificent 7 versus the S&P 493. So on these purple bars, you can see the S&P 500 on average is looking at an 18% revenue increase year-over-year in 2025. This is nearly double what the S&P 493 are expecting. When you look over to 2026, it's the same thing. S&P 500 expected to grow by 17% versus nearly 13% for the S&P 493. So it makes sense why these companies are maybe a little bit higher valued. They have higher PEs compared to the Russell 2000. When the earnings growth expectations are so high, it makes sense that their PE is a 30 instead of a 22. Not only that, but they have amazing track records. You're getting 18% revenue growth with companies that have multi-decade track records of excellence. Companies that have some of the best talent in the world growing at 18%. Usually you would have to look at way smaller companies with a lot more risk to actually get something like that. So it makes sense why the valuations are a little bit higher than normal for the Mag 7. Here's the second point the article brings up. Part of the reason the market has gotten so concentrated is because of passive investing, where investors shovel money into indexes indiscriminately, Woodard said. Passive funds dominate with 54% market share. Regardless of whether this claim is true or not, I just don't think it really matters. Maybe the valuations do get stretched a little bit, but the money that is currently in the S&P 500 or these passive ETFs, they're going to stay there because the majority of people who are investing their money into them are going to leave them there for decades and decades of time. The majority of the people who are invested into these ETFs and mutual funds, they're not buying and selling on a daily basis. They're just simply putting their money in and forgetting about it, and the valuation is going to be the valuation. If the valuations get stretched because of this, so be it, but that's just a new normal that we have to take into account. That's not something that we can correct for. I personally think it's just pointless to think about. Now let's actually compare both the dot-com bubble and the Nifty 50 bubble to what's happening today. The dot-com bubble happened because of internet hype. A lot of people believed that these internet companies were going to succeed. It didn't really matter what the business model was. They just thought, hey, if you have a .com at the end of your name, you're getting my money. Also, during this time, there was a ton of access to capital. It was really easy to IPO. It was really easy to get money. Interest rates were low. The money supply was extremely loose, and investors were pouring their money into whatever they could get their hands on. A lot of it was super speculative. A lot of analysts were hyping up these companies, even though the company's financials were either non-existent or the company business models were super weak. The other thing was when these companies were actually executing their plans, these companies weren't actually earning anything. They were using their name and the internet as a way to just attract investors, attract money, and so the valuations went sky high with absolutely nothing backing them. The bubble finally burst between 2000 and 2002. The profits were not rolling in. The Federal Reserve also hiked rates, and the higher interest rates, of course, tightens the money supply. So borrowing was more expensive, and now all of these companies who were raising money and leveraging debt in order to expand, grow, and operate their businesses, they ended up defaulting. You had mass bankruptcies, which led to the fall of many, many different brands. I personally don't think the dot-com bubble is anything like what we're seeing today. Interest rates are up at above 4%. The Federal Reserve isn't cutting rates willy-nilly. The money supply is way tighter than it is compared to what happened in the late 90s. And also, a lot of the AI companies that you're seeing boom actually have earnings. Palantir, even though I think its valuation is stretched beyond belief, there are earnings and free cash flow growth happening there. Nvidia is printing money like a madman. There are some frothy companies, don't get me wrong. I just don't think it's the majority of what's going on in the S&P 500, and I think it's extremely misleading to compare the dot-com bubble to what's happening today. I personally think the Nifty 50 crash is a lot more comparable to what's actually going on today. So back in 1971, Richard Nixon ended the gold standard, and this led to currency instability and inflation and definitely a ton of uncertainty in global trade. All of this led to a surge in inflation while the economy pretty much just flatlined. There was no growth. And when there's no economic growth and inflation is nearing highs, that increases the risk-free rate and people are a lot less attracted to stocks, especially when companies aren't growing their earnings. So in 1973, OPEC imposed an oil embargo on Western nations, and so oil prices quadrupled. When oil prices quadruple, that means that inflation rises, right? And so this led to super high transportation costs, which just overall increases the amount of money that it takes to do business, right? Transportation is essential for a lot of companies. So as a result of this, to fight the inflation, the Federal Reserve, of course, raised their interest rates as they do. And so this slows down the corporate investments, consumer spending, and of course the stock valuations plummet with the rising risk-free rate. Higher interest rates also mean that corporate profits will generally decline, especially as these companies have to take out debt in order to finance whatever operations they have. The more money costs, the less money that corporations can actually make on what they're producing. The other interesting thing is when you look at the valuation of the Nifty 50, many of them had PE ratios between 40 and 60 times earnings. That's a lot higher than what we're seeing today. Google is at 22, 24, Meta's at 29. That's crazy. That's just way higher than what we see now. Today in the Mag 7, you have Tesla at an 100 PE, but take Tesla out. Your average PE is somewhere in the low 30s, maybe. And that's with Nvidia, which has an expectation of growth of above 20 to 30%. It's very clear that the Nifty 50 had a lot of froth on the top. And so when the oil embargo and surging inflation and higher interest rates and also the currency instability caused by the end of the gold standard in the Nixon era, you're looking at a time of great uncertainty and overall a lack of economic growth. So of course the S&P 500 is going to plunge from frothy values. I'd say the biggest difference though is there were a lot of things that went wrong at the same time in order to cause this crash. Nixon was doing something crazy with the currency. You have surging inflation. You have the oil crisis. And of course, as a result of all of this, you have rising interest rates. So a lot of stuff happened at once. Right now, our interest rates are slowly declining. The Federal Reserve is very slowly and cautiously loosening. Our economy continues to be robust and grow over time. So this isn't a one-to-one comparison, but just for the sake of argument, let's feed into what Bank of America is saying and assume, maybe they're right. Maybe this is pretty close to a one-to-one. We do have maybe some frothy valuations in some companies in the S&P 500, but so what? What happens next? What are we going to do about it? For reference, this is what happened to the Nifty 50 after they crashed. You can see in the early 70s where this crash really takes off and we plunge downward 50%, and we sort of bottom out around here. We only truly recover. I mean, it's almost 1990, by the time we recover. It's 1985, 1986, 1987, where we actually see the account values being equal on an inflation adjusted basis. But if we zoom out even more to present day, this little tiny crash in the 70s pales in comparison to where we're at now. So people who work for these big banks and are on Wall Street and they're bearish on the market, listen, I get it. I understand the arguments, and I also understand that, hey, not everything is perfect in the market right now. There is froth, there are high valuations, and there are really high expectations for what the S&P 500, especially the Mag 7, are going to produce over the next 10 years. But I think when you zoom out, the saying of time in the market beats timing the market is 100% true. It's way better to just put your money in the market than try to predict the next crash. You never know when the crash is coming. And let's say Bank of America is correct. Okay, Bank of America, well, when's the market going to crash? The fact is we don't know, and we'll never know until it actually happens. This is all just part of the game, and I think overall this note from Bank of America to investors is just more noise that we need to really tune out. Here's the thing, guys. The market's going to crash. I don't know when, but it will eventually. But here's the thing, it doesn't matter. It's inevitable. There's always going to be uncertainty in our markets. There's always going to be some level of speculation. There will always be some companies that have a little bit of froth on the top. However, as investors, we have to have a good temperament and stay principled in our approach to how we construct our portfolios. The only thing we can do is buy good companies at reasonable prices that grow, hopefully fast, and print cash. Ladies and gentlemen, if you're not first, you're last. Why would you do anything other than buy good companies? Our portfolios are not there for speculation. Our portfolios are there to be a part of the companies that are able to change our world and provide services and products that will better our lives. The profits that they make are the profits that we will make. The only way to weather the storms, the only way to get through the downturns is to have a gut of steel and to have confidence in the purchases that you make. So, is Bank of America wrong? I would say that the comparisons aren't exactly accurate, but I think a market crash is coming. Just, I couldn't tell you when. I couldn't tell you if it's in 10 years, and I couldn't tell you if it were tomorrow. But a market crash is coming. We'll never know when, and the point is, who cares? Buy good companies, weather the storm, be solid and disciplined in the way that you invest, and carry on, man. Carry on. Bank of America, I love you guys, but what's the point of making people worried? Let's calm down, everybody. Go sip a margarita on the beach and have some fun as we invest and ride the crazy roller coaster that is the stock market. That's the beauty. I hope you guys have a good one. I hope you took something out of this, and if I earned it, please subscribe. Thank you.